Hello, everyone. Good afternoon, and welcome to Stonehearth Capital Management's quarterly market update webinar series, CIO's Corner, for Q4 of 2025, featuring our Chief Investment Officer, Chris Gauthier. My name is Ben House. I'm an associate advisor at Stonehearth, and I have the pleasure of working with Chris today. Now, before we dive into today's discussion, I do have a few quick housekeeping items. First is to please use the Q&A button at the bottom of your Zoom window to submit any questions throughout the webinar. We will aim to answer as many of these as possible during the Q&A portion at the end. Second is, if we do run short on time, either Chris or myself will follow up with you directly to ensure your questions are answered. All right, now I'm very excited to introduce Chris Gauthier, Stonehearth's Chief Investment Officer, who has over 25 years of experience in investment management. He leads our firm's investment policy and strategy, focusing on asset allocation, research, risk management, and portfolio management. Chris, thank you so much for being here. I'll hand it over to you.
Thank you, Ben, for that nice introduction, and good afternoon, everyone. Thank you for joining us today on a very sad day in New England, but at least the sun's out, so we'll forgive the Patriots for giving us a bad weekend. Hopefully, better luck next year. So today, we're going to do the fourth quarter 2025 CIO Corner update. This is where I'll give you an outlook on the current investment environment through multiple lenses, right, including the economic backdrop, which, as this title of this presentation says, is a little stronger than you might have heard or feel in your own personal situation. We'll also walk through what we're seeing in financial markets using sentiment, fundamental, technical data to take the pulse of the markets, and as always, use the weight of the evidence to find the signal from the noise. But before we do that, we're going to start with a brief review of what happened in the previous quarter, just to kind of set the stage as to where we might be going in 2026. And as you can see, it was a very good, strong quarter to end a very good year in the financial markets. There's a lot to like, right? Trend continues to be our friend, with majority of asset classes posting positive returns in the quarter. Really led, like we saw in the third quarter, by gold, up 11.5% on top of a 15% rise last quarter. Anything in yellow is an alternative investment. Just means it's something not in the equity or fixed income land. And the big lead by gold is a concern, right? A slight concern. Historically, it has been a safe haven asset class. But given the strong absolute returns we're seeing in the risk-on asset classes, which is green and blue in the equity land, seems to be more of a statement on geopolitical concerns rather than a financial economic concerns, which matter more to investor portfolios. When we look at fixed income. Now, fixed income will be anything you see in purple, and think about this as credit, bonds. And fixed income, that is want to do when investors aren't too concerned about the economy, was steady performance in the quarter, right? As we're paid to sit and clip coupons, high yield, the more aggressive parts up 1.2%. Short-term treasuries up 1 on the back of a dovish Fed. Long-term treasuries down 1%, and we'll show you why that is when we take a look at the yield curve. This is a healthy sign, right? As any concerns about the future investing environment usually show up in the bond land first. There's an old Wall Street adage, the bond market gets there first, and historically that has been the case. They're not seeing any signs of concerns in the current economic environment. We turn to equity land, and when we say equity, we can see it into two pieces. Anything in green will be overseas assets, international, developed. So think Europe, Japan, emerging markets. Think China, South Korea, maybe some Latin American countries. And then anything in blue is U.S. equity. And as we see, it took a while, but overseas equity markets in green overtook U.S. equity, right? As investors rotated out of this U.S. into the more favorable setup across the pond. See, international up almost 5%, on emerging markets just under 4%, and U.S. equity trailing a little bit, but still very healthy returns with the S&P 500 a little over 2.5%, and NASDAQ right there. Only really weakness we saw was in REITs, way over on the right, a negative 2.3%, but that has historically been a defensive asset class. So again, the risk on parts of the market did very well in 2004, 2025. And that rotation we're seeing across the pond is, not only outside the markets, it's within the U.S. equity market, which is highlighted in the next chart, comparing the performance of value stocks to growth stocks. So what I'm using here is two ETFs from Vanguard, showing this rotation we're seeing in performance out of growth which is that orange line. And when you hear growth, think Mag 7, the Microsofts, Amazons of the world, and into value stocks, which is that blue line. That tend to do better or well when we see good economic growth. And you can see this rotation, and we're capturing here by performance. You can see the value up almost 11% during this time period with growth down 2, really started at the end of the fourth quarter and accelerated as we turn the calendar to 2026. And it really shows no signs of slowing down. And you can see it really accelerated in February. We're showing this up-to-date data here as of February 9th. So again, we do think this rotation could continue into 2026, and we've positioned client portfolios to capture this. So that's kind of where we've been. So now we want to move on to the current environment, right? We'll start with the current state of the economy, which based on the overall data continues to show economic growth in 2026. And we'll start with GDP. GDP stands for gross domestic product. We're looking at just the US data here. And it measures the economic output of a country, right? Really continuing to show accelerating growth. You see that way over on the right end, rising 4.3% in the third quarter of 2025, on top of the strong 3.8% we saw in the second quarter 2025. And this really was driven by continued resiliency from the US consumer, which you can see from the call out makes up almost 70% consumption equals consumer of the GDP. And we also saw continued strong investment from corporations, which makes up another 13%, and the government spending, which is the remaining 20%. When we look at GDP, as reported, it's a great indicator of the health of the economy, right? It tells us how much we're growing, but it tells us where we have been, right? Like even when we look at the data, we're looking at third quarter 2025. That's kind of what happened. So it may not be the best indicator of where we are or where we may be headed. For that, we turn to the survey data and modeling, which are forward-looking. And what we see here, we're looking at is the modeling of real-time data by the folks at the Atlanta Fed, which is that green line you see, the Atlanta Fed GDP Now estimate. They take the real-time data that's out there and based on historical correlations, estimate what GDP is going on in the country right at this moment. And you can see they're very optimistic with this big rise up in January, up over 5% estimated. I'm not quite sure we get there, but we're just at 4.3. So a high 4 on GDP is very good growth for the company. So for the country, I'm sorry. So again, very strong estimated GDP growth. And not only from the Atlanta Fed, we can also see it in the survey data. So what we're looking at here is growth surveys from the federal government. They're called the ISM Services and Manufacturing Indices. When you see the red line, that's services, right? Think consumer, that's 70% of the economy from the previous slide. And manufacturing is the green line. These are diffusion indices, right? So they're based on survey data from corporations. They're asked multiple data points, things getting better, staying the same, getting worse, which are then added together with the reading above 50, indicating economic expansion. So it's a good read on the health of the economy and where it's going. So we can see when we're taking this together, so you take the services, which is firmly in the expansion territory at 54, the slight contraction of manufacturing at 47.9, take those two together to indicate the path of least resistance for future economic activity is expansion. And on a side note, we did get the first data for the manufacturing PMI in 2026, and we actually saw a big rise above 50 in that. So again, the economy is headed in the right direction based on the surveys we're seeing. And with this strength, we're also seeing this kind of like an interesting and easy monetary policy stance by the government, which is interesting when you have strong economic growth. So what we're looking at here is, and I call this chart the real cost of money. It gives us a view into the current state of monetary policy using real-time data. So what we're looking at going back to 1958 from our folks at JP Morgan here is the nominal 10-year Treasury yield. That's just what the Treasury pays. If the Treasury yield is 4.2, that rate is 4.2. And you can see it's 4.18 at the end of the year. From that, we take inflation away. We measure inflation using the CPI, and we get to that brown line, or that real 10-year Treasury yield, which is just above, really around 1.5%. So what that's measuring is what it costs to borrow money. And no matter if it's a mortgage, if it's a car payment, if it's a credit card, all debt is priced off of this risk-free rate from the US government. So it all starts here. So when this is lower, you're starting in a more favorable position. Doesn't mean your individual interest rate is going to be very low, but it's starting from a lower rate. So again, what we can say, looking compared to this chart to history, money's still cheap, right? So there's a lot of money being around that can be invested. And at these levels, it's providing support for that continued investment we're seeing in the economy today, which supports economic growth. Also supporting economic growth is the consumer, right? Consumer's in pretty good shape. Some concerns in that bottom right with student loan delinquencies. You can see that big orange line there, but that's just more policy than anything because we didn't collect student debt payments for a while. And now we're kind of starting them back, but the administration said we're not going to start them back. So again, like anything else there with the current government in Washington, it's a little bit confusing, but we did see a rise in that. But taking it as a whole, right, and using the weight of the evidence, still in a good place. With the most important thing to me is this manageable debt burden, which can be seen on the right-hand chart up here. You can see it's at 11.6. So for better or worse, we're a debt-driven economy. Most consumers have some debt, and as long as they can make that payments, and this is what this is measuring, how much of your disposable income is going to pay down that interest or pay down the principal on that debt, as long as it's at these levels, the consumer can keep on spending. We see back like in fourth quarter 2007, it's that top blue dot right here, it was at 15.8, and we can see that gets a little bit different, but 11.6, pretty manageable for right now. We look to the left, you see the balance sheet, still reasonable levels, very strong position, and we look at the rest of the revolving credit, the auto loans, credit cards, mortgages, still at a lower level. So taking this consumer data, taking it at the aggregate level, you can see the strength of the consumer. But the aggregate data doesn't always tell you the true story. And when we look at the economy, it really is all about the top 20%, as we are definitely in a K-shaped economy, which can be seen quite clearly on the next slide. Now, what do we mean when we say K-shaped economy? Or you probably hear it all in the financial press. It's the top of mind. They lead off all the financial news reports with it. The K-shaped economy is you just think of a K. That top line going out from the vertical line is the top 20%. The other line going heading down is the rest, the 80%. So top 20% is the top line, remaining 80% is the lower line of the K. And you can see it's a very uneven economy, as the chart on the left-hand side is showing the majority of the net worth that's been accruing since 2019 has flowing to the top 20%. Now, that is not good for society, but if you think about financial markets, corporations in the economy, it is good for them because the top 20% account for the majority of the spending, which can be seen right here. We look at this blue line, we're looking at how much of the spending is due to the top 20%, and it's almost 40%. You add in the next cohort, 23, you get over 50% of the economy being supported by that top income level. So again, that's that K-shaped economy. And as long as they're healthy and doing all right, which is a lot to do with the stock market, they can continue to spend and support the economic growth. And the economy in particular, the consumer is expected to get a boost from tax policy as well as tax refunds. Look at the bottom right-hand chart, is looking to grow an estimated 30% this year. So be on the lookout, hopefully, for the taxes, and hopefully we all get those refunds in the mail. Also supporting the economy is stimulus, right? Again, despite the heavy debt load we are carrying, the government continues to spend like drunken sailors, right? Really in an attempt to stimulate economic activity through tax policy. And what we're looking at here is really due to the OBBB. And basically what we're looking at is the percent impact of the legislation on GDP. So you can see that it's really top front loaded in the Q1, Q2 2026, with that diamond representing the total positive impact to GDP, almost 0.5% impact to GDP due to investment incentives, new spending, tax cuts. So again, in addition to a strong economy already, we're adding more stimulus in the beginning of 2026. Also joining the government spending spree is U.S. big tech companies, right? As they continue to pour money into AI investments, as can be seen on the chart on the left, you can see the growth is just tremendous, almost doubling in 2025, another 20%, 2026, showing no signs of slowing. And these are those familiar names. So you hear hyperscalers a lot out there. Just think the Mag 7, right? It's Alphabet, Amazon, Meta, Microsoft, same companies, just a different name, but they're spending tremendous amount of money in the AI investment to keep up with the Joneses. Not all good, right? More spending on AI leaves less cash for stock buybacks, other perhaps more productive investments to support their stock price, because these companies really aren't seeing a return on that AI investment yet. They're investing for the future. But this is more a problem for them, right? But isolated to them and their stock price. As we can see, their free cash flow, which is this brown line, is not headed in the right direction. There's a little bump up expected in 2026, but in general, it's heading lower from, back then when it was 30%. Now we're giving down almost 10% of free cash flow. That's how much money they have to do those other things we talked about, other investments, stock buyback. So while it's not supported for them, they keep investing. It does help other stocks, right? Like value, old world economy companies. And we saw that in the earlier presentation with the rotation out of growth into value. So they may stand to benefit from this outsized investment in AI. But taken to the labor market, definitely not the best picture we've ever seen. Definitely is weakening, really, but not enough to tip the scales yet, right? Because we really started from a position of strength. You can see that we're still creating jobs, right? Created 64,000 in November. The data's a little bit behind. The government shut down, then closed, then open, then shut down again. The data's coming in a little bit scattered. Definitely weaker than we've seen in the past, but again, still positive in creating jobs, so that's good. And as we saw in the consumer data, this reflects more of that bottom 60% of income earners. So painful, yes, but manageable at the total aggregate level. And we look over to the right, we see wage growth, which is that blue line, up at 3.9%. That sometimes takes a while to register with consumers because you don't get that all at once. If your wages are growing 3.9%, you don't get this big bonus. You get a small incremental boost to your paycheck every week or every month. And that takes time for you to register as your income statement and your balance sheet improves, and then you can get to spend more. And this is healthily above inflation, which, while improving, is still a problem out there, right? Some improvement, but not enough to ease concerns. What we're looking here is a top chart in pink is consumer price index. That's that headline index. That's what we pay for everyday goods. You can see it's at 2.71, far above the 2% target by the Fed. The next one down is blue. It's the core, and Fed likes to look at this. This excludes food and energy. Again, I've said it multiple times in these webinars. Not sure why, because everybody has to put gas in their car. Everybody has to feed their family. But that's at 2.6, a little bit lower. Look at the next one in purple, the PPI. Again, that is what companies in the beginning of the production process are paying for raw goods. So that's up at 2.95, above 2%. And look at the bottom green. This is where consumers think prices are going, and they think they're going higher, right? So taking it as a whole, we can see that there is some improvement, but really not enough to make a dent. Now, it may be all right to be flatlining, right? It's not increasing, but for right now, you have a hot economy, easy monetary policy like we saw, and the stimulus that's coming in, not a good recipe for tame prices. So we're really watching this closely for any signs of a pickup. But like we said, for now, good enough. And I really think rates, right, which we will look at in a bit, will be the canary in the coal mine, right, and the most important data point to watch moving forward. Because by the time we see it here in this data, it'll be too late for client portfolios. So next, we'll take a look at the global economy, right? Really closing out the macro, the world economies are in a good spot. What we're looking here is survey data again. Let's think the PMIs we saw earlier for the US. We're now just breaking it down into different parts of the world and individual countries. And there's so much data here. We just use this heat map from my friends at JP Morgan. And you can see anything green means expansion, yellow is neutral, red is contraction. Not a lot of red here, right? We look over to the right that every country is either right at expansion or firmly in the expansion territory. So a lot to like from the global economy and not just in the US. We're seeing good growth across the globe. So taking it all into consideration, the macro data, the signal from the macro data is of a top heavy, right, consumer driven economy, top 20%, that is really being supported by easy monetary policy, which we saw government stimulus and continued investment from corporations, which all should lead to further economic expansion as we begin 2026. That is good for risk assets and highly supportive. So let's turn to fixed income. And fixed income, look at the yield curve. So what is the yield curve? This is the US Treasury curve. And what this is what the government pays to borrow money at different maturity dates, 1 month up to 30 years. And as you would expect, the longer you go out with debt, the higher the rate. Makes sense. That's a good function normal market. And what we saw since the last time we met in quarter ago was we saw this yield curve steepen over the past 3 months. So what does steepen mean? Well, it means that the short-term rates, think about 1 month, 2 months, 3 months, 4 months, you look at the chart there, they declined. And we saw the slight rise in the long-term rates. So upwards to the right, which means a steepener. And when this happens due to short-term rates going down quicker than long-term rates, we call it a bull steepener, right? Really indicating a healthy, growing economic environment in the view of bond investors. So from the bond investor standpoint, this is good in a healthy environment, which in turn is good for risk assets. And we can see that in the lending data too. So we're also looking at fixed income credit trends here. So these are spreads, right, which measures how much corporations have to pay over that risk-free rate, treasuries. Remember, we looked at the treasury rates before in the yield curve. So every lending starts with that rate, and then they add on an individual company's risk. And if they think companies are a risky borrower or not may not be able to pay the money back, they ask for a higher rate. So when you see higher rates, you think more risk. And what we're looking at here on the credit spreads is the high yield in blue and the corporate in green, which expect high yield to be higher because the more risky parts of the market, but very low compared to history, right? It actually declined in the month and showing no signs of distress in the credit market. So if there was a concern about the health of the economy, we would see the borrowing rates start to rise. And we're just not seeing it in the data. And then we look at prior history. So at the 20-year average in blue over here, where it was in December, you can see we're well below historical averages. So from the bank standpoint, the lenders, the private credit, the people who actually lend money to these corporations out there, they're not seeing any stress in the financial system, which should be a good positive environment for risk assets as we move out into 2026. Now let's turn to the equity market. I'm going to put this bull market in historical perspective, right? While very strong, up 91%. You can see over here in the top right corner, you can see how much we've actually increased since 2023, 90%. When you look at previous bull runs, it may have some more room to go, right? The last one's 114, then we have a 400%, then we have a 100%. So again, it is very strong, but it's not extreme compared to history. So you want to be on the right side of these long-term trends. And for right now, the long-term trend of the bull market is upward and to the right. And even when we take a look at the data that's more recent data, I'm only looking back here to 2021, so what it's saying is what's going on in the market. What we're looking at is the S&P 500 on a weekly basis close. That's that red and black line. When it's red, the market declined. When it's black, the market went up. You can see it's headed upwards to the right. So what we call that is a strong technical backdrop supporting future price appreciation. Well, what do we look for to see if it's strong enough? Well, the first thing you want to look for is those moving averages, right? That's the blue and red line. You want to see those sloping upwards to the right because that means prices are rising, which is good. You don't want to see any flatlining. You don't want to see that turning down, which we don't see at all in the market. We also look at that red and green line, which is support and resistance, right? And you can see back in 2024 and 2025, it acted as resistance. It just couldn't break through. And then once it finally did, you can see it went on to make higher highs continuing. So now that becomes support. So as long as we kind of stay above that line, that's a sign of a healthy equity market. Look at the RSI, which is a top chart. That's what we call the overbought, oversold indicator. And what's just looking for is sentiment. Is sentiment too elevated? We maybe do a full pullback, and that level is really around 70, and we're at 61 right now. So again, still elevated, still close, but nowhere near signs of worry. And the last thing on the bottom is the MACD, and again, that is just short-term momentum compared to long-term momentum. Black line and red line, you can see that while they're very similar, close together, that means short-term momentum and long-term momentum are in harmony. So again, taking all those into consideration, we have a very healthy bull market picture. Helping support this technical picture is the fundamentals of the equity, right? So we're looking at S&P 500 again, EPS growth going back to 01. You can see it estimated for 11% 2025. Excuse me. And then 2026, we got 15% and 27, 15%. So again, good estimated growth. And still, more importantly, record high profit margins. Not good maybe for society, but very good for corporations at 13.9 and almost at an all-time high there. And again, when you think about profit margins, that's just how much money they keep after paying all their expenses. So the higher that is, the more money they're making, the stronger their fundamentals, and they can reinvest. So this is all good for corporations because as we know, strong corporate profits drive long-term returns in the stock market. And right now, corporations are doing very well. Right? And it's not just the level of earnings, but the momentum of earnings, right? Which is very strong. So what do we mean by momentum? When we see momentum, we look at upgrades and downgrades. And what we're looking at here is this right-hand chart over here, this EPS revision, 3-month up to downgrade ratio. So what does that mean? Well, all it does, it looks across the globe from the S&P 500 all the way down to the emerging markets in China, looks at individual corporations, looks at the earnings estimates increasing or decreasing. When there are more increasing than decreasing estimates, you have a level above one, which means that's more positive earnings momentum. More companies are doing better than expected. And we can see across the globe, except for a little bit in Europe, everybody is above one. So again, just not the level, it's the momentum, which is a healthy sign. So given this backdrop, record high profit margins, strong earnings momentum, corporations seem to be in a very good spot as we begin 2026. What we're also seeing support the market is breadth. And now we're turning to the global market. We see ACWI, that's All Country World Index. It does include the big chunk of the US, but also adds in international, EM, Latin America, Europe, Japan, all those countries to kind of see what the health of the market is in breadth. And we can see from that middle chart, the 50-day moving average, that a good 70%, or a little bit below 70% of companies are above their 50-day moving average. Those are things we saw of the S&P technical chart. If more companies than not are above that moving average, that's strong because markets are strongest when broad. And we're seeing good breadth in the 50-day. And we're even seeing better breadth in the 200-day moving average, which is the bottom chart, which is firmly in the 70% range. So again, not just in the US, but seeing strength across the globe in equities from a breadth. What is a little concerning is sentiment, right? Sentiment is elevated and approaching concerning levels, but it's just one input to the decision tree. So what are we looking at here? So we're looking at the S&P 500 up top. Down below is friends from Ned Davis crowd sentiment poll. And you can see when it's above this dotted line, it means there's extreme optimism in the market. It means a lot of people are excited about the market, the so-called animal spirits. Now, that's not necessarily a bad thing, especially when you see strong fundamentals, and doesn't really hurt the markets as long as that remains positive. When we start getting concerned about this is that when it starts to fall below 65, this dotted line. So again, we can stay in this position for a long time. We've seen that throughout history that you can stay elevated and still see good returns. It's when it starts falling down that you can start to see some market wobbles and some equity weakness. We're just not seeing it yet. So yes, it is elevated, something to be concerned with, but until we really see that turn down, it's not too negative impact on the markets. Don't think about valuation. We do know that U.S. markets are overvalued. Supportive of the rotation we saw in the fourth quarter performance, right? Investors continue to lean into asset classes that have good valuation support, and that's anything in green here, away from those bad valuation or high valuations that are in red, more expensive, top-heavy U.S. market. And value can be found away from the passive headline indices you hear quoted in the financial press. So rather than just look at the S&P 500 like that's the only equity market in the world, we look at across the globe. And you can see when you're willing to move away from those headline passive indices that are really expensive, you can find some good value. You see Brazil, India, trading at very decent valuation levels. Even in Europe, while not at the best levels, are still very good. So again, not being pigeonholed into just buying the S&P 500, you can tilt into better valuation setups across the globe, and you can kind of see investors doing that, coming to where we are already in our client portfolios, taking advantage of this better valuation support we see in other parts of the market. So I did promise the canary in the coal mine. We talked about inflation and what we're kind of watching and what we're going to see that would change our minds a little bit. And this is really what is the most important chart, in my opinion, to keep an eye on. So we're looking here in the top chart, it's a 10-year treasury rate. We've seen that in other charts we've shown. And we're adding the 2-year treasury rate in red and the bottom chart, S&P 500 performance. So concern for us, if we would see a meaningful rise in the 10 or 2. So the levels to watch for, so when we think about the 10-year, we look throughout history, the 4.5 rate seems to be that point of no return where markets start to get nervous. And 4% on the 2-year. So again, well below that, no signs of worry. But if they start breaching that level, like we saw in the beginning of 2025, equity market can start to wobble and sell off, right? So that's kind of what we're looking at. Not there yet. Rates are really behaving. You see the not really moving too much, not a lot of volatility, and staying in that good range. So as long as we stay below those levels, in the interest rate market, we do think this bull market can continue and inflation won't be that big of a problem. But it's something we're watching very closely. So with that, let's turn to our risk modeling, right, and see what that can tell us about the investment environment, kind of sum it all up together. So what we're looking here is the NDR Fab 5. This is our friends Ned Davis Research, so one of our research partners. It's basically 30 indicators broken down to 4 categories. You can see the 4 categories down here. Think technical, sentiment, pretty self-explanatory, monetary, self-explanatory. Combo, just looking at overseas assets and performance and all those moving averages to kind of get an indication of where the market is from a risk perspective. And you can see since the last time we met, it was a slight drop to -1, right? But still on a buy signal from July of this year, right? And we really need to see this from the historical data fall below 1.5, a -1.5, before we get a change in the signal. So again, the signal through the noise from the Ned Davis Research Fab 5 is that it continues to be a positive environment for leaning into risk assets until we get below 1.5, and we're just not there yet. For those of you who have joined us on these calls before, we know we also have our own internal risk model, and which is really confirming the signal we saw from Ned Davis, right? Despite some signs of weakness, the model is still not in the negative zone. It's a neutral 0, down from 3 since last time we met. This model is meant to be additive, not duplicative, meant to complement, right? They can disagree, but when they're aligned, it definitely gets our investment committee's attention to ensure client portfolios are aligned with this signal. So we look at our internal model, look at the technical picture. Still supportive, right? Down here, as you can see, a +3 and a neutral equals a +3 from a technical standpoint, really based on a strong structure, right? We see good breadth, the right parts of the market outperforming, really helping point a positive technical picture for the marketplace. We see the positive support from earnings, but not enough to tip the scale, right? S&P 500 is still overvalued territory, and valuation is not supportive of equity prices. But like we saw in the previous chart, there are pockets of valuation support to like and to invest in. Think about international assets, those small caps, if you're willing to look for them. Turning to macro, it's still supportive. It is at 0. Again, we saw jobs being weak, so that's a negative impact. We saw the manufacturing, which just turned positive, but at least for this run of the model, it's still negative. Offset really by strong copper prices, which is, they call it has a PhD in economics because it leads the production cycle. So if that price is going up, there's more demand for copper, more economic activity, and new orders, which again, self-explanatory. If you get more new orders into the system, you have more economic activity going on. So all taken together, macro still supportive of the risk asset environment. Then we look at qualitative, right? And qualitative is really anything that can't be captured in a quantitative model. Not everything can be quantified. And to us, uncertainty still rules, right? From the administration, from tax policy, tariffs, backwards and forward, however you want to call it, all the noise coming out on social media, it just creates so much uncertainty in this environment. So that's still going to act as a drag for risk assets. But putting it all together, until we see differently, the bull market gets the benefit of the doubt because we put it all together. The weight of the evidence and the signal is pointing towards a healthy environment for leaning into risk in client portfolios, which can be seen in our asset allocation on the next chart. Now, this is just a typical allocation to a moderate client of ours. Signal of our risk modeling is reflected in client portfolios by our overweight to equity. You can see that top line over there. In particular, overseas, right? As we lean to better starting valuations, we saw that in international developed. I'm starting to see that in performance. We did add to EM stocks, right? The emerging market, which moved client portfolios to an overweight position in the quarter as we want to lean into asset classes with strong trends and good valuation support. So we really like those markets over there. With the current rate level, strong economic backdrop, we are finding some opportunities in the more aggressive parts of the fixed income market, right? And it's reflected in an overweight position. Still underweight the U.S. Again, a lot has to do with just the big impact the S&P 500 plays in that asset class, how concentrated it is, the overvalued. Still like some asset classes. Don't have a 0 weight. We do have some decent exposure to the U.S., but just not in an overweight position, given the valuation starting points. And finally, cash defensive hedge. We're underweight cash, really offset with that relative strength strategy, which has exposures, at least for the moderate clients right now, to gold in emerging markets. And with a very positive influence in the quarter on performance. The trend is still our friend. So that's kind of where we are. Time to sum up before we get to questions. A few key takeaways I want to leave you with, right? We saw a consumer global economy, really strong position here, right? Indicating further economic expansion ahead based on the total aggregate of the data. Inflation, a little bit more work needed, but still have dovish monetary policy, providing short-term stimulus. Don't fight the Fed. Valuation in equity markets concern, right? But still strong technical, healthy corporate earnings. The trend is still our friend in the US and international developed equity markets. Fixed income market, no signs of stress, right? And that's what the fixed income market is, right? It only kind of gets to the forefront and makes noise when they see stress. And we can see with the returns and the interest rates, not a lot of stress. So the long feared bond vigilantes, which you hear about, are still quiet. And until they make noise, it's going to be a positive influence on the risk environment. And in total, weight of the evidence from the multi-factor risk models, while not giving the all clear, are really still pointing to further strengthen risk assets as 2026 rolls on here. So with that, a few compliance notes, appendix, compliance disclosures. I'll turn it back to Ben, see if there's any questions out there.
Chris, thank you. That was all really great. Yeah, we do have a few questions here. Let me start off here with the first one. What is your price target for the S&P 500 for 2026?
Thanks for the question. Yeah, as Ben knows in all our meetings and everything like that, we don't put much stock. I spend a lot of time thinking about targets on financial assets. Data shows majority of firms who release target levels. I mean, they spend millions of dollars, employ hundreds of people whose only job is to forecast it, and they still can't even get it close, right? Not even right at all. A lot of wasteful energy, money, no information is just more noise for investors to sift through. I mean, when we take a look at financial markets, we look at more at probabilities and directions more than levels. We compile the data, weigh the evidence to come up with the most likely outcome for an asset level, given the current situation. This disciplined process does lead to better outcomes and helps us stay on the right side of the most likely outcome. And given the data we're seeing in the market, really the most likely outcome with the highest probability is for continued rise in risk assets, including US equity. So we don't have a target price. We let the weight of the evidence guide us to overweight or underweight decisions on particular asset classes.
Hmm, very good. All right, second question here is what do you make of the recent price action in gold, silver, and crypto? And is it telling us anything about the markets?
Yeah, it's been exciting, right? Gold, silver, crypto, for two different reasons, right? More excitement on the gold, silver, maybe a little bit disappointment on the crypto. Um, yeah, I mean, we take a look at those asset classes. It does enter to our investment committee's decision process. But I think, together we really have come to the conclusion that it's more of a concern. There's a slight concern, right? But the performance is more about the uniqueness of each asset class and the whole of the respective asset class rather than a commentary on risk assets in general right now. Take Bitcoin, right? You hear a lot about digital cash, safe haven, characteristics of the asset. But you look at the data, just the price action alone, down 40% from its highs. So it's more of a speculative investment, really driven by highly speculative traders rather than investors, right? You can see in the performance, it acts like the NASDAQ on steroids and is really driven by liquidity. Not a very deep market, not a lot of trading going on, which really leads to wide price swings as investor sentiment flips from bearish to bullish on no data, just pure speculation. So not a lot of signal for me for other asset classes. Gold and silver, on the hand, are more alike, right? And they are traditionally been a safety asset, which investors tend to buy when they're nervous. So it is telling about investor sentiment. But as we look in the market right now, the biggest buyers by far are central banks, right? Which are called captured buyers, right? They don't buy or sell on outlooks if they think it's going up or down, but on the needs of their balance sheet, right? So when they have cash in hand, they need to buy financial assets, someplace to store their money. With the long-term trajectory of government budgets, which is not good across the globe, the current geopolitical climate, and there's a lot of anti-US sentiment, so a lot of people do not want to own US treasuries right now. I think they see precious metals as a better investment for the needs, creating buying pressure and pushing up those prices. And on top of that, we also see investors buying as well to hedge their portfolios for the same reason, right? Really creating some more upward pressure. But we don't see massive selling of other financial assets to fund these purchases from those investors. So that would be a concern. We're just not seeing it. So for now, there's probably a little froth in both, and they're not currently a cause for concern to other asset classes, but something to keep an eye on, but not too much of a worry right now.
Awesome. Very good. All right. Looks like we have one last question here, and it is, if the economy is as strong as you indicated in your presentation, and how come I don't hear about this in the press?
Um, Good question. The data does point to a strong economy here. You know, I, so if you listened to my presentations before, I really don't like to bring politics too much into these presentations or into the investment world. I think it's a separate issue most of the time. But at least for this question, I do think it comes down to politics, right? Like it or not, and I really don't like it, politics drives the current news cycle, right? And it doesn't do right now either party any good to talk up the economy in this environment. So we don't hear that much about it, right? Politicians' number one concern is and always has been, right, to get elected or reelected to maintain whatever power they have. And we have a midterm election right around the corner this year, right? So if you're Democrat, think about you're a Democrat trying to run for reelection, or even better, unseat a Republican, you're loath to talk about anything positive, right? It hurts your election chances. They're better off talking down anything that's happening right now, as Republicans are in control of all three branches. And they don't want to give their opponents any wins in front of this election. Now you flip that to the Republican side, and on the other hand, they would love to talk up the economy, right? But they really can't, given all that negative consumer sentiment data that is out there. People just don't feel good about the economy right now. They want to remain in power, and they go around telling people how good they have it, but the people don't feel it yet. Think about that K-shaped economy we talked about. The majority resides under that 20%. They hurt their chances in the midterm as well. So, due to politics, we have a whole bunch of people saying nothing about the economy, which is why we let the data do the talking for us, right? And the data has been really, really good. I just wouldn't expect to hear much about it until it benefits one party or the other. And there's no benefit to either party to talk about it right now.
Awesome. All right. Well, that seems to be all the questions we have so far. But as I mentioned at the start, if you have any further questions or if something comes up as you're going about your week, please do not hesitate to email, reach out, either Chris or myself. We'd be happy to answer those for you. And with that, this concludes our Q4 2025 CIO Corner. Chris, thank you again.
Thank you, Ben. Thank you, everyone.